Hi, friends. Welcome back to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
So today we want to get into the main stories that kind of caught our attention in the markets. And so the first one is there was actually the second bankruptcy of, well, I should say second auto parts dealer like manufacturer bankruptcy of the cycle. So there's a company called First Brands that filed bankruptcy back on September 28th when they couldn't refinance $6 billion of debt. And it's come out over the last few weeks that there was probably some like fraud and stuff going on and some like Enron-style accounting shit because essentially there was something like $2.3 billion of assets that have like essentially evaporated overnight. And so we're going to touch on some of the interesting issues that have arisen as a result of this because there's all this exposure in the private credit world. Like Jefferies had a significant amount of exposure. I think UBS had a significant amount of exposure. So we're going to get into some of the ripple effects as a result of this this deal. But it's actually so interesting too because of the conversation we had last week about what's going on with JP Morgan lending to EA and like this whole transaction. And it's like, what's going on in the credit boom? And it's like, oh shit. I mean, there's a little bit of storm clouds when it comes to almost like the consumer side of things, especially on the automaker, in the automaker aspect. So we're going to touch on that a little bit. Jen did a news article, or I should say, did an article in the newsletter about gold. So we're going to talk about how that is just as an asset class, it has been on fire. And so Jen's going to talk about why it's trading at such a high valuation and like what it means. And then the last two things, there was an article, Jen, you sent me this, and it was something along the lines of like, Ferrari-loving trader who burned Wall Street with bond bet leveraged 11,000 to 1. And I was like, what is this, Jen? You were like, no, this is so vanilla. This is so boring, but she's going to get into what that actually is. It's a cool headline, but like,
and
it's
a couple
so not
of
as
you
sexy.
did reach out in our DMs asking us to talk about it. So ask and you shall receive. So
Seriously.
we're happy to. We are like trained circus monkeys. And if you ask us to talk about something, we always try.
And then the last thing we're going to get into is there's a lawsuit from a former analyst, I believe, at Centerview, who, again, filed a lawsuit, and it was not dismissed. I think a lot of people thought it would be dismissed on summary judgment or whatever it's called. And so we're going to get into our feelings on that. So why don't we actually start, Jen, with gold, and then we'll go into the First Brands next. So
awesome. So we did a podcast episode ages ago with our dear friend Guy Adami, who is one of the hosts of CNBC's Fast Money. And he used to be a metals market maker when he was on the street. And investing in gold is something that a lot of people kind of talk about. And I feel like it's kind of one of these like old man shaking fist at the sky kind of thing. Like my dad's generation, I feel like has always allocated something to gold as a very like old school traditional hedge for the rest of your portfolio. And we'll talk about the fundamental reasons why people have always invested in gold. But it's been all over the news lately because we broke through to record highs in an environment where that might not necessarily seem intuitive. And there's a number of different reasons, fundamental reasons why. And then there's a lot of speculation of other forces that may be behind that move. So thinking about investing in gold and why people allocate some portion of their portfolio to it, there's really three main reasons. Number one is when you think about the different things that you can buy typically as an investor, you buy stocks, you buy bonds, you maybe invest in currencies, you maybe invest in commodities, things like that. It's very difficult to strip out real assets, meaning things that have intrinsic value within those portfolios. When you think about stocks and bonds, right, in particular, you have, for example, interest rates, the interest rate that you're receiving on a bond. When we talk about the US Treasury yield, let's say a 10-year note is yielding 5%. That nominal yield doesn't protect you from inflation. So if you were supposed to receive 5 cents on the dollar every single year for the next 10 years, but prices go up by 3, 4, 5% every single year, that purchasing power of the dollars that you're getting in the future diminishes. So we often talk about what are called real yields, and real yields are nominal yields minus the annual rate of inflation. And so owning real assets, things that have some kind of intrinsic value to them, is the opposite, right? They are theoretically protected from inflation. They will hold their value and not be negatively impacted by the rate of inflation. So that's one reason to own gold. A second reason is simply diversification, right? Gold tends to move in ways that are very different than stocks and bonds, but also different than currencies. In fact, it tends to move inversely, so it tends to be negatively correlated to the price of the US dollar. And we can talk about why and a number of different theoretical reasons. But remember, there's a long history of gold being tied to currencies. We used to have what's called the gold standard, where like banks actually had to have in their reserves physical holdings of gold to back that paper currency that was then traded. And we did away with the gold standard in the 20th century. And the last thing is to have something that is effectively a safe haven asset, where I can own this thing, where if everything's going to hell in a handbasket and we have to go back to like physically bartering with shiny objects, I have this thing, right? There's a scarcity value to gold. You can't just print gold. You can't just, it literally doesn't grow on trees, right? There is an actual physical cost to mining gold. A lot of you have grown up in the world of digital currencies and you talk about mining. The language of mining comes from actually mining gold, from how like the mechanics of these old school currencies were built. So those are kind of like the three main reasons that people own gold. The disadvantage to owning gold is it doesn't kick off any income for you. It's not a bond that pays a coupon. It's not a stock that pays you a dividend. So there is de facto a cost to owning gold. You have to believe that it is going to go up in value and you can sell it at a higher price in the future or use it for something versus owning a dividend paying stock or owning a bond that kicks off cash flows and give you stability. So typically, where I'm going with all this is that gold tends to be something that people flock to in a low or zero interest rate environment because you're not giving up anything by owning gold when you could be receiving nice, juicy coupon payments from a high interest rate bond, right? And even though we just cut rates in America and rates have rallied off of kind of the recent highs, we are still not in a zero interest rate environment. And I think that it's potentially puzzling as to why you would move all of your money into this asset that doesn't kick off any yield. I think something to think about, though, is even though nominal rates are very high, inflation has been not very high, but relatively high. Inflation has been sticky, right? So if you take that nominal rate, you are subtracting more from it to get to your real rate, because of inflation being a relatively high number. Therefore, the real rate that you are foregoing isn't that high. So that may be a little bit of a false comparison in people's minds. The other thing is over the last year, we've seen a big push from people who are concerned about the dollar's status as the global reserve currency, and from people who are concerned about the lack of fiscal discipline in the US to move out of the dollar as far as what central banks are holding and what they're invested in, into something that feels safer. So gold is becoming that safest safe haven asset. And then lastly, there has been this activity. There have been something on the order of magnitude of 10 central banks that have been identified as being big buyers of gold in the news. And that list, this shouldn't shock you, includes governments like China. It also includes other governments like Kazakhstan and Ghana and Turkey. And so as there have been more sanctions put on countries like Russia and Iran, there is this, talk that a lot of the gold buying has stemmed from a lot of these countries wanting to circumvent those sanctions and using that gold as de facto part of like a payment system or something like that to, again, get around those sanctions that have been put in place against those countries. So all of this has combined to drive gold up to the local highs. I think actually we've come off a little bit. And what tends to happen, and like I am not a technicals guru, but you tend to break through these record highs. And then if you're like a DeMark indicator person or something like that, like we'll go back and retest right before you can break through again. So I think a lot of what has happened since all these articles broke earlier this week about gold breaking to new highs and retracement is there's been some profit taking. But because gold is denominated in US dollars, I think it's also really interesting to think about the fact that the dollar has rebounded off of the lows that we got right after the September Fed meeting when they cut rates. So it is not as cheap to buy gold for these foreign countries as it was 2 or 3 weeks ago. So I think that also may be like cooling off, just, we're talking intraday over the past like 48 hours, gold no longer soaring as high as it was. While all of this happened, there was an Economist article that came out, I think a week or two ago. I don't even know what day it is, about this potential 25, 25, 25, 25 plan. I mean, the four square plan, whatever they were calling it, basically suggesting that retail investors, instead of the traditional thinking of 60-40 stock bonds, that you should have 25% of your portfolio in equities, 25% in bonds, 25% in cash, and 25% in gold. The theory being that, okay, equities will give you that juice from great growth. Bonds will give you that stability and kick off some income for you. Cash gives you optionality and it, okay, if things go really wrong, I've got some liquidity on hand. And gold gives you that hedge against everything else and that true safe haven asset. I think it sounds wild to keep 25% of your portfolio in gold. But if you are talking about 25% of your portfolio in real assets, think about, again, real estate, land, right?
Yeah.
Things that have intrinsic value, tips even, which are real assets, treasury, inflation protected securities. Okay, if you're super concerned about inflation, I can understand then a 25% allocation to real assets still sounds really high. So this is kind of all of the backdrop. This is why I think gold has been breaking to recent highs. I think there's technicals. I think there's actual demand. And I don't know about you, but every other podcast I listen to, like, why is gold not sponsoring us? Because gold bar companies seem to be sponsoring every single other podcast that I listen to. I hear ads for gold daily. So it also may be just like retail speculative, like buying frenzy. Yeah. So that was a really long-winded speech, but that's kind of my take on what's going on in gold. Questions, comments, concerns?
Yeah, I just think it's so strange that like anyone is putting out that you should be allocating your investments 25, 25, 25 when they don't know your age, they don't know your net worth, they don't know, like there's so many things that go into that decision. Like, I mean, anyone who's, I don't know, it's like I'm a dummy when it comes to a lot of personal finance, but I think like the main advice is always the younger you are, the more you should be invested in equities and like riskier things. Because by the way, I mean, we had that conversation. It's like back to the whole like FIRE, right? Like whatever the hell that stands for. But like you want to be, you want to have your money grow for you. And especially when you have the ability to lock it away and not touch it and not be worried about the drawdowns and the ups and the downs, like put in a higher percentage when you're young. But then when you're older, right, you need to be living on like a fixed income.
You need income.
Yes. So that's the stupidest thing that like there's some blanket thing that like everyone should do. And by the way, it's like, if you're some person who needs to buy a house, you probably need to have more in liquid assets because you're not going to want to risk a drop. So like, sorry guys, no, you should be using a little more judgment than like listening to some random article about 25, 25, 25 for everybody. No.
Yeah, I mean, one thing that I will also caution, we don't give personal finance advice here in this podcast. You can open up any Reddit blog, any one of these, publications, and see a different theory, a different portfolio allocation theory, with various insane extremes, because that's what gets clicks, right? That's how the FIRE thing caught on, right? Mm-hmm. How these things like become ingrained in the public consciousness. Everyone's always trying to tell you that they have like a genius hack for how you should invest. And that's not our shtick here, because guess what? Like there is no magic bullet. And like you said, Kristen, to your point, it does depend on so many other variables that there is no one size all solution for truly any one investor. I think there are sound fundamental principles behind thinking about allocating your portfolio, not just to one thing. But it's funny because I do think there are so many young investors out there who think I should just be 100% in equities because they've never seen the market go down. Right. And so I do think that it's interesting in the environment where that has been, do I have food on me? Where that has been the prevailing theory. Sorry, you can keep that in, I'm a mess. It was just the light reflecting off me, apparently. But when everyone is just like, the market goes up forever, why would you even bother investing in other things? That all of a sudden it actually sounds quite radical to have an investment thesis that you should be as high as 25% in cash and 25% in gold. that doesn't kick off a dime of income, that sounds pretty extreme to me. So of course, that's why it's getting attention, and that's why we're talking about it here.
Of course. But to your point, there's never any one size fits all for anything. Like, it's like, what is your situation? And it's so dependent on obviously like what you have going on. Anyway.
But yeah, so to the TLDR on that is, it does seem a little wild that gold is going up so much in an environment where rates are not zero and when the dollar has rebounded off the lows. So that is why I do think we are getting a lot more chatter about why these central banks are buying, what they're doing, what's really going on here behind the scenes.
Yeah.
So that's that.
Well, it is interesting. We actually had someone today who reached out because we had put out like a talking head on the electronic arts LBO, which we obviously talked about last week. And someone said, "Ooh, can you do more private equity?" And then they said, "Or should we like be looking more into distressed debt?" So we've talked about how Jen and I are not distressed debt experts, but we are getting someone on who is going to be doing our Distressed Debt 101 podcast in November, which we're super excited about. But in the meantime, we're starting to see some of, like I said, these bankruptcies. And it's interesting to note. So I mentioned First Brands and Tricolor. I don't know how to pronounce it. Tricolor. I have no idea. But they're two companies that are in the auto space. Tricolor is auto lending, used car dealerships. And then we have First Brands, which is in auto parts. By the way, just to like go back to like what happened in 2008. Like, well, not only was there the whole like housing bubble, but guess who also got bailed out? The auto companies. So anyway, details. So the main thing that happened, as I mentioned, so First Brands is a much bigger deal because of the sheer size of it and also like the number of banks that have exposure. So essentially what happened is you have this boring kind of industrial parts maker. And obviously there's been, and it was financing a lot of its growth through debt. And as I mentioned, it then tried to do a refinancing. The main idea is you have some debt that's coming due, $6 billion worth, and they couldn't make, they couldn't go through the refinancing. So they wanted to do what's called a Chapter 11. Now, Chapter 11 means you try to like reorganize versus with Tricolor, they're doing what's called a Chapter 7. They're liquidating everything. So those are two different ways that companies can go through a bankruptcy proceeding. But First Brands was trying to just like restructure itself. And what's happened is they found that there was a lot of shenanigans that were going on. And so if you think about, we had done a podcast a while back with Carrie Finley on asset-backed lending. And so one of the things that you see with a lot of these different types of, whether it's auto loans or whatever, is you see like invoice securitization, like consumer invoice securitization. So it's like so someone's supposed to be paying the company, they haven't gotten it yet. So like that invoice gets sold off to somebody else so that the company can essentially monetize it now. And there were situations where like there was the same collateral used to raise debt in multiple like this is why a lot of the assets are like not there because they were using the same underlying collateral to try to like raise debt. So that you had a lot of—
So dumb it down. So I have an invoice that says somebody's going to pay me $50. And then I then show that piece of paper to 3 different lenders and say, lend to me based off of this, right?
Yes. Well, and I'm not sure if I think they did. I think that's called like hidden factoring. Again, I am not a distressed expert, but for example, I'm much more used to kind of if you were to get something like an asset-backed loan, like typically when you go out and you raise debt, a lot of the times it is secured by collateral, meaning, you are going to raise debt and it's financed. The collateral is like a building or it is your working capital that you have.
Or
so it
like
could be your inventories, your
have lying
receivables.
around.
Exactly. And so that is the underlying collateral that you are using to raise the debt. It's what the lender is using to get comfortable that worst case scenario, the company takes a turn for the worst. You are then going to be able to go in and take hold of that inventory and sell it off. You are going to get those receivables and you can now wait and just collect the money. And so you will be paid back. That's why last week I was talking about the recovery when you talk about loans is usually much higher. Like it's not zero, right? Equity, typically you invest. I mean, you assume that you could get wiped out. With loans, you typically assume that you're going to have recovery. The more senior, the higher you expect to get. So it's oftentimes the assumption that you would see often like in a CLO model is you're going to get 70 cents back on the dollar. Now the problem becomes when there's underlying fraud. And I mean, there have been allegations of almost like Enron-style shenanigans going on. But the fact that there's all these like weird different subsidiaries where they were like possibly using the same collateral for multiple loans. And so that is why the amount of assets that they should have to cover the liabilities is just not there. That's why again, this allegation that I think something like $2.3 billion is evaporated overnight. And in this era of the private credit world, and remember, by the way, so this is a huge bankruptcy, the liabilities, I believe they have both. This is another thing. There is on the books liabilities, and then there's off books liabilities. And so you can sometimes think about for on books liabilities, like your balance sheet, you were going to see this is the amount of debt you have, this is whatever. Off balance sheet liabilities, this was a huge issue again in the 2008 financial crisis because, for example, you could have pension liabilities, meaning you need to be paying out pensions for employees, and that is a liability that's going to use cash flows that the company has, but it doesn't show up on the books. So that's something they call off balance sheet liabilities. And again, there was both on balance sheet and then off balance sheet financing, which becomes a problem. So again, on the liability side, there was something like 10 to 11 billion dollars. So as we're thinking about the blast radius, if you will, there's this fallout that is potentially problematic for the private credit landscape because Jefferies and UBS have exposure to this company via I believe Jefferies, it's called like Point Bonita is the private credit fund, and then UBS is like O'Connor Fund. And so one of the things that I was trying to understand through some of the Financial Times articles is like, does Jefferies have any actual of their own capital that they are putting into this, or is this like a fund that they are managing that is outside investors? So again, and I said to you, I was like, I was not able to make sense of what this Financial Times article was explaining. So I believe Jefferies does have some exposure to the actual like loans in that fund, but I think that it is also money that's coming from other outside investors as well. But you have Jefferies, you have UBS's O'Connor Fund reportedly had like
UBS
30%.
O'Connor, I haven't heard that name in ages. That's like
Well, so they have,
literally
like,
a name I haven't heard since 2006.
30% of its portfolio, which is tied to that, which is actually very high. And then they did mention that there potentially are CLOs that have some exposure. But again, this is like downright fraud. So anyway, I mean, people have been talking about like, is private credit a bubble? I think one of the things that Jen, you and I were talking about too, is like, it's easy to hide fraud when things are going well. It's hard to hide fraud when things are going poorly. Like usually what happens is like when there's any kind of downturn or when there's any kind of stress in the system, that's when fraud is found out. And also, again, in like this whole world of private credit and credit spreads at such tights, what happens is that you have investors that are looking for yield and saying, that's okay, we can get a little bit more lenient with the covenants. Maybe instead of having the maintenance covenants where we have to test every quarter, we'll just deal with, have it be incurrence covenants where, we'll just monitor and make sure that you're not, spending more cash than you're supposed to. So the lack of oversight, because you have these investors who are looking for yields and they can get additional yields if they're a little more lenient, potentially is problematic. So look, people always say this, right? History doesn't repeat itself, but it often rhymes. Like we've seen this play before. I remember in 2007, right? The Cub Light loans were like a big deal and then they freaking went away and it's like they're back again. So anyway, just kind of interesting. And yeah.
No, I think just to double click on what you just said, if you will, I really do believe that, listen, it's human nature, right? Fraud is happening. And you have to assume that under like average circumstances, there's some layer of fraud underlying everything. There's some layer of people circumventing the checks and balances. But when the checks and balances start to relax a little more, it does create that more permissive environment for fraud to happen. And then all it takes is for something to go wrong and you find out very quickly where there were wrongdoings. And I think that's a good segue into our next conversation about our Ferrari loving trader. So you guys, but concurrently, right, I do want to say we had been getting asked in our DMs, hey, private credit's falling apart. Should we be worried? And we've been like, listen, you've got to look for concrete examples of things. And the private credit markets are designed in a way that obfuscates stress. It's literally designed so that you don't have 25,000 bondholders who all know the second something goes awry. It's designed so you can renegotiate with one lender. And depending on whom that lender has obligations to, then you either get more widespread knowledge of this, or it's just like, hey, between us girls, like, I'm not going to make this payment. Let's figure something out, So what happened with this trade gone awry was something that happens all day, every day. Somebody sold short a bunch of bonds. But let's talk about short selling. The mechanics of short selling in any market are that you are selling something that you do not own. And the mechanics of doing that is you need to borrow said security. It's always easier, I think, to think about these in stock terms because that's what most people are familiar with. If I think that Apple stock is going to go down and I want to benefit from that, there are a number of different ways that I can do this. I can buy a put option. I can do a number of things. Or I can go borrow a bunch of shares of Apple, sell them to someone, and then hope that the price goes down and I can buy them back at a lower price and then return the shares that I borrowed. Now, the mechanics are a little bit more complex in the bond markets, but they're not that dissimilar. And so in order to sell short US Treasuries, you enter into what's called a reverse repurchase agreement, and you effectively go out and borrow a bunch of bonds from a dealer. You then sell those bonds into the market to another dealer, presumably, or the same one or whatever. And then you hope that the price on those securities goes down, that rates sell off, and you can buy them back at a cheaper level. And then you give back the securities that you borrowed. However, the actual regulations around short selling in the bond markets are a little bit different than they are in the equities market. And I'm not a regulatory expert by any means, but dealers are doing this all day, every day in such high volume that, like, if you're a dealer and you happen to find yourself naked short for 5 minutes or whatever, it's not a big deal. You don't need to be like, don't worry, I've located these bonds, right? Because these portfolios within these banks are turning over to the tune of billions of dollars in each direction every 5 minutes. Now, there's whole teams of risk controllers that manage this process. But what I can tell you is that in order to be a client of an investment bank, and to trade with that investment bank, to trade fixed income securities, you go through this whole vetting process with back office, with compliance, with risk or whatever, where they look at your assets under management and they basically are doing a credit check on you, right? Like, hey, how much money do you have lying around? What's your cash, et cetera, et cetera. And that then determines, okay, when you enter into one of these repurchase or reverse repurchase agreements and you want to borrow $100 million worth of bonds, are you getting $100 million worth of bonds? No. You might be getting $95 million worth of bonds. You might be getting 90. You might be getting 80, right? Like, the haircut is determined by your creditworthiness and your standing with the bank. And so I guess what this trader did at the end of the day is in February of 2020, he thought
right before COVID.
Right before COVID. He really had a strong view that rates in the US were going to sell off, meaning go higher. So he got short a bunch of long bonds. Here, I'll bring this article up in front of me. So all told, this guy got short 2.6 billion long bonds.
Oh, wow.
Now, just off the top of my head, that's not a small trade. The DVO one, meaning the sensitivity of this instrument to every 1 basis point move in interest rates, let's call it something like 16. So 160, 123 times 20. What did I say? 20. Okay, so he was short like 4.2 million in 01, meaning for every basis point that interest rates sell off, he would have made $4.2 million. He didn't do this entire trade with one bank. He did what's called spraying the street. So and the way that this Bloomberg article is written, by the way, makes it sound like this was like this complex process of getting into this trade. So it was like, he arranged a trade for $5 million worth with this bank. Then they arranged a trade, whatever. Here's what happens, okay? The guy calls up his sales coverage to me and goes, hey, bid 50 million long bonds. Actually, it's not even calling anymore. Half of this is all done electronically. It used to be that he'd call Jen and he'd be like, hey, bid 50 million long bonds. And I'd stand up and I'd yell at my bond trader and I'd say, hey, bid 50 bonds for our buddy at what? And by the way, the name of his fund is like one of these cartoon names that like combines all the traditional tropes. We always joke that like, it's like Tree Point Stone Rock. This was Black Brook.
And wait, so really quickly, it was 50 million long bonds? I thought it was 2 billion.
2.6 billion.
Yeah,
but he did it in clips. He did it in different clips with different banks. Okay. he didn't call up Citigroup and say bid 2.5 yards of bonds. He was like, okay, I'll do this size here and this size here.
Okay.
So, but also like bad client behavior, because if you were a dealer, you want to see the whole risk, right? And you want to take that down. And so he's going to each bank and being like, hey, like, and so he's spraying the street with all this risk. And then those traders have to go out and hedge, and they're moving the market against themselves, and then everyone else is doing the same thing. So like traders were probably pissed at the guy anyways once they realized he was spraying the street. Long story short. But what does not happen in this process is the salesperson or Bob the trader, for every single trade that comes in on the wire, you're not like, oh, well, let's look at the balance sheet of BlackBrook or whatever. This is all like a risk control back office thing that happens, right? Where they're saying like, hey, this client is in good standing with the firm. Like, you're not managing that. And the size of the institutional clients that we were dealing with were so large. I mean, it's coming from BlackRock, right? They've got $11 trillion in assets under management. They come in and ask you to bid 50 billion bonds. You're not like, or 50 billion. They come in and ask you to bid 50 million bonds. And you're not like, oh, I'm so sorry. Could you just tell me what what your latest repo trade was? Like, you're not doing that. You just don't know, because you assume that's all being handled behind the scenes. And that's what these banks have armies of risk controllers and back office people doing all day, right? Is making sure that it's okay for this guy to do a trade. And so this guy had like $5 in his fund and put on this huge trade that was de facto levered 11,000 times to 1, because I think he had like less than $250 million in assets under management. So he put on this trade and had not sourced to the borrow for these $2.6 billion worth of long bonds. So 2 days later, the trade and bonds settled T+1. So he puts this trade on and then never delivers the bonds, right? Like he said, I'm selling you these bonds, and does not deliver them. Well, what happens is when, like I said, the trader facilitates the inquiry, right? They're taking risk, and they are taking the risk of now all of a sudden owning these bonds, right? And so they go and they sell on the other side, right? So they hedge that risk. They aren't just sitting there being like, well, I hope that guy's wrong. I'm just going to sit on 2.5 yards of bonds as a favor to Mr. BlackBrook.
So they're now short. They're
now short. And they're expecting to be delivered bonds by the guy who sold them to them. And a day goes by, and another day goes by, and they're like, where the hell are my bonds? Why is this guy failing to deliver? Because he has no bonds to give them. And this was at the exact same time that COVID hit and the lockdowns were announced. So instead of selling off, the market rallies hard.
Oh my God.
And so the market makes a huge move. And so this is what happens. We only find out about fraud, about wrongdoing, and about just like stupidity when things go against people.
Okay, but I want to also like do some simple math. So you said the DV01 was 4.2 million for every 1 basis point move. Now,
something like that. Let me just double check
that. Back of the envelope math, because I wanted to look up where were rates in 2020. Now, I am a inept little moron.
But so look at 30-year rates. Yeah, 30-year rates in Feb 2020.
30-year rates, Feb 2020. Looks like it was 3.72%. Okay, so we're going to call it 3.7. So that is 370 basis points. And then where does it go? Let's call it April 2020.
March. So look up like March 8th.
March 8th. Okay, so March 2020. Where are rates? They go to 3.29. So that is 50 basis points. So 50 basis points times 4.2 million, that's $210 million that these poor banks got short trying to hedge because this moron decides that he thinks rates are going down. They just think that they're back to flat and they're not taking a positional view, but they possibly lost $200 million. Again,
it ended up being 250. Yeah, your back of the envelope math is pretty good. So the street lost $250 million on this guy.
Wow.
But again, so here's the other thing, right? So what ends up happening is when the guy fails to deliver, like at what point were these traders not just like, okay, I'm going to stop out on my short, right? It also is puzzling to me, like how it took so long for the traders to just be like, okay, this guy's a dick. Like, I'm done. I'm sorry, pardon my French, but it's just a disaster. But this is like a basic risk control compliance thing. It's just the way that the Bloomberg article is written. And I think the way that the layperson reading it might interpret it is like, this is a massive failure. Like, these traders should never have facilitated. Like, this guy should never have been allowed to trade with the bank. So it is a failure of risk controls and things like that. But this wasn't some like super complex derivative trade that no one can understand. He was doing just the most like basic dumb shit. And I don't know why he thought he was like going to get away with this. And of course he like is the worst possible timing. And that's why this became such a huge loss.
Yeah.
I don't know why we're only
Well, it's like
finding out about this
SVB.
now.
And this is the second time I did this. SBF. We were talking about this yesterday, where it's like Sam Bankman-Fried. The irony is like, had there not been that like crypto winter and all the stuff that went wrong and blah, 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 I mean, he'd probably be like Elon Musk level rich right now, because he actually had made a lot of good investments. And like, I mean, ultimately when they did go through the bankruptcy with, oh my gosh, what was the name of his firm? SBF's firm? FTX. When they ultimately went through the bankruptcy, I mean, people who bought in to like those, like they made so much money. So the recovery was, again, insane. That's what I'm saying, right? When you look at some of these like recovery stuff, depending on the situation, like things can do very, very well. But with Sam Bankman-Fried, I mean, the money, it like, and even I think it was Michael Lewis, he talked about like the money like ultimately was there. Now that was a case of just like kind of, I mean, the way that they had painted that was he was kind of just like scatterbrained. By the way, guys, you should go back and listen to our Going Infinite review. We were talking how we need to do and get back to more of these reviews. We also want to do Enron, Smartest Guys in the Room. We have a whole bunch of books that we want to get into again. But the main point is that like, usually it's because of something bad happening that it's like, holy shit, like look at all this
stuff.
There's
an exogenous shock or something that nobody predicted.
A lot of times had that never happened, like all these people would get away with it because like, I mean, you only find this stuff out when things go wrong. So
yeah,
anyway.
I mean, we had a great conversation very early on with Anish Mitra about how over a long enough time horizon, you know what I'm saying? And it's like, well, if he'd just been naked short and been able to hold the position for 5 years, he would have been fine. You know, like
he would have been a hero.
Yeah, exactly. Yeah. But so everyone who was asking about that, that's what that was. And I feel like, again, really bad for all these people who lost their shirts, but this is like just sheer stupidity that like this guy was just naked short and failed to deliver. And like the bombastic way that the Bloomberg article is written, it's just like, and there were Ferraris involved. Like what was happening is people were like, who the F is your client, right? And the poor salesperson's like, let me Google the guy. Like, I'm a first-year analyst. This was the first account I was ever allowed to cover, probably. And they're looking him up on Instagram because that's what the kids do these days. And it's like him showing off his Ferraris or whatever while he's naked short, 2.6 yards of long bonds when he's got $2.5 million in the fund. Okay, really quickly, because I got to go pick my kids up from school. There is this Centerview Partners wrongful termination / disability claim. This was brought to our attention by someone who is one of our followers. I feel like last year, like a while ago. And basically, I'm going to read a little summary here just for brevity. So I guess Catherine Schreiber, who started as a junior analyst at Centerview in mid-2020, alleged that she was terminated after she disclosed a medical condition, mood and anxiety disorders, that required her to get 8 hours of sleep per night. And basically, like, Centerview was like, hey, you're a first-year investment banker, like, maybe you could like stop working every night at midnight or whatever, like, and you don't have to come in before 9. A lot of back and forth ensued. He said, she said, whatever, right? So I think the general feedback from the financial services community was, hey, listen, we've had a lot of tragic incidents that have happened, going back decades at this point, but especially in recent years, where people who were working 100-hour work weeks or more and feeling, and who had underlying health conditions, whatever it may be, right? Taking stimulants, who knows? Like, these poor people died at the end of the day.
Yeah.
Like, there is no excuse for working people to the bone in this industry and working them every single weekend and taking away their lives and blah, 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 blah. However, 8 hours of sleep per night. Kristen, I don't think you've gotten 8 hours of sleep per night in like 20 years at this point. Yeah. That is, listen, it is something that we all aspire to. I get great sleep every night, but like it may not be a reality. Like 8 hours of sleep per night is kind of neither here nor there. It's just investment banking, especially at a junior level, is not a 9-to-5 job. It is a 9 to midnight job for a lot of people. And
so it's funny, right? As someone who like has my Oura Ring, I have my Apple Watch, like when she says she needs to get 8 hours of sleep, how many hours does she need to be in bed to yield that 8 hours? Because I mean, I can tell you if I go to bed and I'm 8 hours in bed, I am not getting anywhere close to that amount of sleep. Now, I don't think it's an unreasonable request to say I want to be in bed and not working for 8 hours a day. I think that that is like very reasonable. On average, I should be getting, I mean, okay. And again, to your point, like you don't work past midnight. You don't start before 9. I think that's very reasonable. I don't think there's anything unreasonable about that. I question, like, because I just she just wanted the 8 hours that she like didn't have, because I think that's reasonable. But like, is that all she wanted, or was that the whole, like, that's what I'm confused by.
So her accusation is that she was de facto being asked to be available around the clock, right? That someone might send an email at 3 a.m. and expect a response or whatever, or being asked to work on a Sunday and things like that. And I have not gotten too in the weeds with the legal case here.
I want to look this up.
I just think that I think there is the extreme of people who are literally working themselves to death. I do not think that this is what this woman was being asked to do based on my reading of the case.
Yeah. So, I mean, it's funny because I was just like, also, I mean, I'm so in this like pregnancy world where, I mean, I have a friend, she's a birth photographer and like a doula. And it's like, she was pregnant and would be literally at all hours of the night. She'd have to be on call and she'd have to be able to like go. And so again, like if you need that type of sleep, then don't be a doula. Don't be a birth photographer. So, same thing with investment banking. So I don't think it's unreasonable to say I need 8 hours of sleep a night. But again, if it's like I can only work 8 hours from 9 to 5, you're in the wrong job. So that's what I want to understand. Like, and saying if there's an emergency, I mean, I don't know. When I worked in banking, like I never would get an email at 3 a.m. and be because like you don't even have your phone on. So that's why I'm just like, I'm a little surprised by the expectation that like you would have your phone on all the time and like reply to an email. Like that does seem extreme. But so is that like the case? I don't know. Like that's, now I'm like trying to look into this article a little more because I'm like, what are the sleep needs? I think like midnight to 9 seems reasonable. Trying to like have someone answer an email at 3 a.m. if you're not a doula. Yeah. I mean, I could see like, you're probably not going to even get your phone. But I feel like this, I would be shocked that Centerview is not saying like, we can work with that. So
well, again, what they said was, we'll put a hard stop at midnight for you. And then she was dismissed shortly thereafter. So her accusation is that they basically like were just paying lip service saying, yeah, we're willing to do this. And then they were like, we can't deal with this woman. Like, F off.
Well, yeah, I do think there has been a little bit of this sentiment amongst some people. Like, I want to be clear because the people that we talk to who are young are so hungry to learn, are so driven, and are just like actually like really wonderful. And I feel like I've only seen like the best, but I also do think there's an air of entitlement amongst some people where it's like, I can't believe you asked me to get a coffee, right? I can't believe, oh my gosh, you asked me to not go to my dinner at 7 p.m. that I have. Like, who are you to ask me to do that? So I think if it was like that type of an attitude, I can totally see why she was let go. Like, you're in the wrong job, my friend. But if it was so bad, and we have seen some situations like that with like some of the deaths that have happened and like where people are being worked to the bone. I mean, if that was the culture, then I think Centerview is in the wrong. But if like, I'm just curious, like what the reality was. And it's probably like, there's always 3 parts to every story, the whatever, the bank's hers and then it's the truth. So I'm curious what the actual situation was, because I don't think that asking for 8 hours of sleep a night is unreasonable. I think it would be unreasonable if you were a doula or a birth photographer. At the other end of the spectrum, if she was trying to hold boundaries that were like a little bit too extreme, you're in the wrong business. So, I think we're not given enough information here.
Also, like, there's sales and trading, right? Like,
go be Jen's job. Yeah.
Go work in a different role within the bank. Like, I don't know. I didn't get 8 hours of sleep a night as a first-year analyst, and I wasn't on a desk that asked me to be in the office until 3 a.m. every night or whatever it is. And people are working from home increasingly, and there are so many different things about it. So I think, listen, the reality is investment banking is not a 9 to 5 job. And if those are your limitations and that's the best job suited for you, trying to fit a square peg into a round hole, I do think that firm culture has, we know at some banks, some room to improve.
Yeah.
But like I keep saying, I think that there is the one extreme of all the terrible things that happened over the past few years. And we all agree that there's no excuse for that. I want to work a 9 to 5, right?
Yeah.
Because if you think about it, if you're going to have a life and you're going to eat dinner and you're going to have coffee and you're going to shower and things like that, you know, setting that hard and fast limit, that's kind of what you're asking for. Like, it's just the wrong industry for you.
It's the wrong job. Yeah. I also would probably advise against having kids. I'm just going to leave it at that.
Yeah. And I mean, I also don't want to be dismissive of mental health concerns. You know,
no.
I don't know what her like mood and anxiety disorders are, that the prescription is 8 hours of sleep. I'd be hard pressed to find a doctor who's not going to tell you that you should be getting 8 hours of sleep. Like, so I just don't know enough about this particular medical condition, but I don't know any doctor who's going to tell you that 8 hours of sleep is bad for your health and who's going to tell you that you should get much less than that. You know what I'm saying? Like, I just don't know the specifics, but I'm slightly skeptical of, and prove me wrong, right? Like, please, I've never had a doctor tell me, like, you know what, you should really get 5 hours sleep a night. Seems really good for you.
Sleep less. Yeah. But I mean, that's why I was just making that kind of comment. Like, I wasn't even like trying to be snarky, but I mean, I do think that there are situations and realities where like, you're just not going to be able to get that, like having kids. I mean, to your point, I have a 7-year-old, a 5-year-old, a 3-year-old, and a 3-month-old. I have not gotten 8 hours of sleep in like 8 years.
Yeah, you haven't.
So, I mean, I slept better when I was a banker, but also in investment banking, I mean, that's the whole thing. Like I never did get, and I had a good group, but I never, ever would expect to get an email at 3 a.m. and someone expected that I replied to that. Like, I think that is a little unreasonable because most people don't have their phone right next to their bed. But back to your point, like, I mean, I go back to my birth doula thing. Like, if, like, in some cases, people have to do that. So maybe her boss did say that. I guess it is possible. And if they did, I think that is a little bit cray cray. So, yeah.
So we'll see how this all shakes out. A lot of people think that this is going to really reshape, that if she wins this lawsuit, that it's going to totally reshape how investment banks work. I don't think so.
Oh, that I can say that this is every single freaking, I mean, year. It is the type of thing where you see someone say, okay, like literally, I remember in like probably 2012 or something, thinking that they had totally upended the work requirements and there was like all these
the work from
times
home.
And I thought that it was like a total change. And that's why when I started to hear about these deaths and stuff, I was like, I thought that they did change and they haven't. So I don't think it's going to do much of anything. I mean, we've talked about this before. I still don't understand in the world where we have AI and these tools that can help supplement jobs, where we have so many companies that have international offices. I mean, you should have a team on the other side of the world that can be working when you're sleeping and vice versa. I mean, with these firms that are international, I don't understand why they can't have the complementary offices working together to get projects done. But with that, Jen, I know you have to go pick up your kids. So thank you guys so much. We have just an amazing pipeline of guests coming up. So we have the COO at a mega fund. We have the head of wealth at a mega fund. We have the global head of investment banking at a major investment bank. We have so many amazing conversations coming up. So we are so excited. But again, if you are enjoying our podcast, please leave us a written 5-star review and we will see you next time. Bye, guys.